Hello everyone, welcome to Tesla Daily News. Today is June 30th, Monday, and the following is the latest Tesla news. According to our market data, Tesla's stock had a powerful surge in the latest trading session. Shares opened around $381.79, dipped to roughly $379.30 at the low, and rallied to a high near $413.27, finally closing at about $411.84. Trading volume was heavy at roughly 57.4 million shares, well above typical days, and the previous close was near $379.71, so the advance was more than 8% for the day. From a technical perspective, strong breakout above resistance, high volume confirms bullish momentum. This move puts Tesla firmly back into a leadership posture among high-growth names, and the strong close near the intraday high suggests that buyers were in control into the end of the session. For investors, this kind of wide-range, high-volume up day often marks renewed institutional interest. It will be important in the coming sessions to watch whether the price can hold above the $400 area, which now becomes a key support zone in the short term. According to finanzen.net news, the next potential catalyst for the share price is just around the corner: Tesla's upcoming delivery numbers. The report notes that the market is watching these figures with considerable tension, but at least one expert has turned more optimistic, suggesting that investors could see a positive surprise when the official delivery data are released. The article also points out that Chinese competitor BYD remains a significant rival and is lurking for any sign of weakness from Tesla. From an investor's standpoint, delivery numbers are one of the clearest, high-frequency indicators of the health of Tesla's core automotive business. Better than expected deliveries can validate demand, support revenue growth expectations, and justify premium valuations. On the other hand, any disappointment relative to market forecasts could quickly pressure the stock, especially after a sharp one-day rally. The mention of BYD underscores that the competitive environment in electric vehicles, particularly in China and increasingly in Europe, remains intense. For long-term shareholders, monitoring not just Tesla's raw delivery count but also its regional mix and pricing power against BYD and other Chinese brands will be essential. Finanzen.net also hints that analyst sentiment has begun to improve marginally after a period of skepticism about Tesla's growth trajectory. An upward shift in tone from the analyst community can matter because it influences institutional allocation decisions and can lead to estimate revisions. If deliveries indeed beat expectations and analysts raise their forecasts, Tesla's recent technical breakout could gain further fundamental backing. According to xAI from Germany, another important development for Tesla investors is the changing index environment around Elon Musk's broader ecosystem, especially SpaceX. SpaceX shares are being added to the widely followed MSCI World and MSCI All-Country World Index. While this news is directly about SpaceX, not Tesla, it has important implications for how global capital is allocated across Musk-related companies and for how investors think about overall exposure. The xAI report explains that the MSCI World is a core benchmark for many equity index funds and ETF savings plans, particularly in Germany and Europe. With SpaceX entering this index, large passive funds that track MSCI World are forced to buy SpaceX shares to replicate the index composition. Because the free float of SpaceX is currently only around 4%, this index-driven demand can support SpaceX's valuation and potentially amplify volatility. For Tesla enthusiasts and shareholders, there are several angles to consider. First, even after SpaceX's inclusion, Tesla remains a much larger weight in global indices such as MSCI World, with about 1.3 to 1.4%, compared with an estimated initial SpaceX weight of only about 0.1%. This means Tesla continues to be one of the dominant Musk-related exposures in passive portfolios worldwide. Second, the article highlights that the concentration risk in MSCI World is already significant. United States companies account for almost 3/4 of the index, and a small group of mega-cap technology names, including Tesla, make up over 24%. Investors who hold Tesla directly, plus broad market ETFs, might be more heavily exposed to Tesla and to the Musk ecosystem than they realize. The arrival of SpaceX into major indices could modestly increase that correlation over time as index providers and ETFs give more weight to Musk-controlled companies. Third, xAI discusses how other indices are handling SpaceX. The Nasdaq index family has relaxed some rules to allow earlier and heavier inclusion of large companies with low free float, which could accelerate passive flows into SpaceX. By contrast, S&P Dow Jones is holding firm to stricter inclusion criteria that keep SpaceX out of the S&P 500 for now, due to profitability and free float requirements. similar to Tesla's own long road before it finally joined the S&P 500. For Tesla shareholders, this history is a reminder that index inclusion can be a powerful long-term catalyst, but it is usually tied to sustained profitability and scale. Looking ahead, a potential increase in SpaceX free float through insider share sales could eventually raise SpaceX weights in indices like MSCI World. That development might slightly rebalance how passive capital is distributed between Tesla and SpaceX. Investors who are bullish on the Musk ecosystem overall may see this as a positive diversification of exposure. Those who are more cautious may want to monitor their aggregate Musk-related risk across individual holdings and ETFs. According to TV2's automotive site Broom in Norway, Tesla is continuing to invest heavily in charging infrastructure, introducing a new level of supercharger hardware in Europe that could significantly improve the user experience over time. The report explains that Tesla has installed its first V4 power cabinet in Europe, located at Hellerudsletta in Lillestrøm municipality near Oslo. This new cabinet supports up to 1000 volts and a theoretical peak charging power of 500 kilowatts, a substantial jump from the previous 400-volt, 250-kilowatt systems. The V4 stalls around this new cabinet feature longer cables and support card payments directly, making them more compatible with a broad range of electric vehicles beyond Tesla's own models. 8 charging posts at the Lillestrøm site are connected to the cabinet, with a total site capacity of about 1200 kilowatts shared across all stalls. While this means that not every car will see the full 500 kilowatts at the same time, it still represents a meaningful step up in potential charging speed, especially for vehicles that support 800-volt architectures and very high charging rates. For Tesla investors and owners, this development matters on several levels. First, infrastructure leadership is a key part of Tesla's long-term competitive moat. As more non-Tesla vehicles adopt the company's charging standard or connect via adapters, a faster, more capable network strengthens Tesla's position as a central player in the broader EV ecosystem, not just as a car manufacturer. Second, higher power capability anticipates the next generation of Tesla vehicles. The Broom article hints that it is reasonable to expect new Tesla models or refreshed versions that can take advantage of higher voltage and higher peak charging rates. Faster charging reduces one of the key frictions in EV adoption, which can support vehicle demand, improve customer satisfaction, and justify premium pricing for both cars and charging services. Third, offering card payment and long, flexible cables makes Tesla's network more accessible to competitors' electric cars. This opens additional revenue streams, effectively turning the supercharger network into a cross-brand energy and services business. For shareholders, that diversification away from purely vehicle sales toward network and energy-based revenue could smooth earnings over the long term and increase the overall value of Tesla's ecosystem. According to El Español's El Android Libre, Tesla is also expanding its presence in Europe through new distribution and mobility models. The Spanish telecom giant Movistar is broadening its successful device renting program to include electric vehicles, and Tesla is among the premium brands featured. In this model, Movistar customers can obtain vehicles by subscription-style monthly renting contracts, rather than buying cars outright. The article notes that Movistar's renting offer, originally focused on smartphones and personal computers, is now being extended to cars from brands such as BYD, Tesla, and KIA. The entry-level monthly fee is quoted at about €397.65, and the package includes required maintenance services, insurance, and roadside assistance, simplifying the cost structure for drivers. Tesla's models sit in the premium segment of this catalog, while BYD and KIA offer more mainstream alternatives. For Tesla enthusiasts, this is significant because it increases access to Tesla vehicles for consumers who might be hesitant to commit to full ownership or large upfront payments. Subscription-style renting lowers the barrier to adoption, especially in markets like Spain where economic conditions and regulatory environments are pushing drivers toward low-emission vehicles but where price sensitivity is high. From an investor perspective, the move illustrates how Tesla can benefit from partnerships that extend its reach without building all the retail or financing infrastructure on its own. Telecom operators like Movistar already have millions of customers, billing systems, and marketing channels in place. By plugging into those networks, Tesla can potentially accelerate unit growth and brand visibility in Europe with comparatively low incremental cost. There is also a strategic angle. Movistar is positioning itself at the intersection of digital connectivity and sustainable mobility. Tesla's presence in this offer aligns its brand with that broader narrative and may help Tesla win mindshare among younger, tech-oriented consumers who are comfortable with subscription models for everything from phones to streaming to transport. If this type of car renting proves successful, it could be replicated by other telecoms or service providers across Europe and Latin America, expanding Tesla's addressable market. According to several reports from India's free press journal, First Post, and the Times of India, Elon Musk's AI company xAI is ramping up its efforts, and Tesla is directly involved as a key testbed. Grok 4.5, the latest large language model from xAI, has entered private beta testing at both SpaceX and Tesla. The model is built on xAI's new V9 foundation model with around 1.5 trillion parameters and includes supplemental training data from AI coding platform Cursor. These articles note that early internal evaluations suggest Grok 4.5 can perform at a level comparable to, and possibly better than, Anthropic's Claude Opus in some areas. Musk describes the V9 model as a solid workhorse in the same league as Opus, not necessarily something that will immediately dominate all benchmarks. More importantly, he emphasizes that reinforcement learning and rapid iteration are steadily improving performance, and that xAI plans to release entirely new, from-scratch models roughly every month for the rest of the year. For Tesla investors and fans, the key point is not just the model itself, but how it will be used inside Tesla. The check coverage from CZ underlines that Grok 4.5 is being tested on real-world engineering and operational problems across the Musk ecosystem, including Tesla and SpaceX. Tesla generates vast streams of data from manufacturing, autonomous driving development, energy products, and enterprise operations. Integrating Grok into these workflows could enhance software development, accelerate autonomous driving progress, optimize manufacturing lines, and improve overall efficiency. Musk has also moved some of his top Starlink and Starship engineers into AI work, and Cursor's team is contributing directly to training, not just data provision. This suggests that Tesla's future technology stack, especially around autonomy and internal tools, will be closely intertwined with xAI's foundation models. If successful, this vertical integration of AI across Musk companies could become a major competitive differentiator for Tesla, allowing it to develop more advanced driver assistance, better in-car intelligence, and more efficient internal processes than rivals. From a capital markets angle, an acceleration in AI capability could influence how investors value Tesla. For years, part of Tesla's valuation premium has been based on expectations around full self-driving and software-like margins. Concrete evidence that Grok-enhanced systems are improving autonomy metrics, reducing development cycles, or generating high-margin software and services could reinforce that thesis. However, the reports also caution that independent benchmarks have not yet confirmed Musk's performance claims, so investors should watch for third-party evaluations, real-world use cases, and measurable business outcomes at Tesla before fully pricing in this AI upside. Bringing all of this together, the latest developments paint a picture of Tesla as a company at the crossroads of several powerful themes. The stock is showing renewed strength on heavy volume, just as delivery numbers, a critical fundamental catalyst, are approaching with the potential for a positive surprise. Globally, Musk's broader ecosystem is gaining more representation in major indices through SpaceX, which may gradually reshape how passive capital flows around Tesla and related companies. On the operational side, Tesla is reinforcing its infrastructure lead with next-generation, higher-power superchargers, starting in Norway and likely expanding to other European regions. In parallel, new distribution channels like Movistar's renting program in Spain are making it easier for everyday consumers to access Tesla vehicles without large upfront commitments. Finally, the integration of xAI's Grok models into Tesla's operations points toward a future in which AI is not just a side project, but a core engine of innovation inside the company. For investors and enthusiasts, the coming months will be crucial. Watch how the stock behaves around the $400 level, monitor delivery results and guidance, track adoption of the new charging hardware and renting partnerships in Europe, and look for concrete evidence of AI-driven improvements within Tesla's products and operations. The combination of market momentum, infrastructure investment, new distribution models, and deep AI integration could define Tesla's next chapter. Thank you for listening to Tesla Daily News. If you enjoyed this episode, please subscribe and stay tuned for our next update.